Most important factor in getting your business acquisition loan approved is your debt service coverage ratio, or DSCR. Basically, it's a measure of how much cash the business generates relative to the loan payment. Think of a DSCR of 1.5 times as the business can make 150% of the loan payment, or a DSCR of 0.9, meaning the business can only make 90% of the loan payment, meaning you can't pay your loan. So the minimum requirement for the SBA is 1.15 times coverage. In reality, most banks probably aren't going to do a deal at that coverage ratio, and you shouldn't want to. 1.25 is really the standard minimum for most banks. Everything else about the deal is going to have to be really good to get it done. Again, I'm not sure you want to do a deal that's only 1.25 times covered, but the bank will probably do that loan. For larger deals where there's a lot of goodwill, meaning that the assets of the business are lower, some banks might require up to 1.5 times coverage ratio. So if you have over $2 million of goodwill, some banks will say we need 1.5 times, versus maybe if it only had $1 million of goodwill, they would do it at 1.25. And the banks that we know that will do the loans on top of the SBA, so the pari passu loans that allow you to borrow up to $7.5 million on SBA terms, they want to see 1.65 times on the coverage ratio. So here's how you calculate your DSCR. So start with the business's tax returns, not the financial statements, because that's what the bank's going to use. They're going to use the tax return. I like to start with net income, and then I add back the interest, depreciation, the amortization, the owner's salary, and any benefits that are going directly to the owner. This line, think a car or personal travel, things like that, things the business is spending money on, that's really just a perk for the owner. So now this gives you the cash flow of the business or the seller's discretionary earnings. Next, we have to subtract out your required salary. So the bank's gonna look at what you need to just make your mortgage payments, your car payments, your general debt payments, and determine a minimum salary that you need to take. They're gonna subtract that from the cash flow. So this is totally based on you. If you have an expensive lifestyle, they're gonna take a big number out. If you live a very frugal, very cheap life, they're going to take out practically nothing. And then subtract out what you expect to spend annually on CapEx. So that's new machinery and new equipment. Now this gives us your cash available for debt service. And in this instance, we just gave an example. It worked out to be about $400,000. Then we're going to take that number and we're going to divide it by the annual debt payment. In this example, we're saying we're buying this business at 3 times the annualized cash flow, $580,000. So we're buying a $1.74 million business, which means the debt payment's gonna be just under $300,000 per year. So that makes our debt service coverage ratio 1.33 times. Now the key to remember, and I think what a lot of people miss, is to subtract out your required salary and to subtract out that CapEx need. So looking at this deal, you can probably get this done. It's above the 1.25 times, but it's a little close for me. You're not gonna have a lot of room for error at 1.33 times covered.